What is happening, investors? It is your boy Jack, and today we're going to speak about some stocks that will more than likely be hit particularly hard the start of this month. I think a lot of us expect May to be a particularly poor month. Over the weekend, Warren Buffett came out and said that he has sold all of his American airline stocks. This isn't only going to have an effect on airline stocks, but every single stock within the travel industry sector as a whole. So, you know, your airlines, people like Boeing, the people who make the planes, who make helicopters, even people like Carnival, any sort of cruise line operator. It's going to affect all of them massively. You could even stretch it as far as casinos and hotels, people who, you know, rely heavily on travel to get to these places. So a lot of stocks in these sectors are more than likely going to be hit very, very hard, and they're the kind of ones I want to focus on in today's video. Today's video will be more speculative in nature than usual, just because a lot of it is going off what we expect to happen next, somewhat after this interview with Warren, and then somewhat just in general. We will still, of course, speak about balance sheets and all of the stuff that we always speak about, but there will be a fair bit of speculation. I want to get that out there from the start, and these definitely aren't the safest companies. We're not talking about Johnson & Johnson, Procter & Gamble, Pepsi, anybody like that. Last week we went up over 800 subscribers, which is absolutely crazy to me. If we can do even half of that this week, we're going to be right close to 3,000 subs, so please help me out. If you're not subscribed yet, hit that sub button right now. Drop the video a like and drop me a comment. All of that is going to help this video rank in the YouTube algorithm. You'll be directly supporting me, and I can keep making these videos every single day. So let's get to 3,000 subs, baby, and let's get straight into today's video. So for the first time, I am seriously investing in a second airline. I have been all about Delta from the start, but I've been doing more and more research into Southwest as of late, and they are looking very good. Now, this does not change my opinion on Delta whatsoever. I still absolutely love Delta, and I still plan on investing in them every single week, and we actually are going to speak about them today. But I want to put some time into Southwest Airlines. Southwest have recently just reported their Q1 earnings, so I highly advise you to check that out in full if you want to. But to summarise, while air travel demand fell off a cliff in March, Southwest Airlines benefited from strong performance in January and February. As a result, they posted a modest adjusted net loss of 77 million for this first quarter on revenue of 4.2 billion, which was down 18% year over year, so not terrible considering everything that's happened. Obviously, the second quarter is going to be a whole lot worse, but it was not an absolutely terrible first quarter. And right now, they've done a great job of cutting their expenses, and they've limited their quarterly cash burn to around 3 billion, so that's every quarter. Southwest has built up a fortress balance sheet. At the end of the first quarter, they had 5.5 billion of cash and short-term investments, and just 6.3 billion of debt. Between then and April 24th, okay, so a very short period of time, the carrier received half of its CARES Act payroll support funds, over 1.6 billion, and drew down an additional 2.7 billion on a term loan. As a result, the company had over 9 billion of cash on hand by the time its earnings report last week. So a lot of cash on hand considering what their current expenditure is. And it doesn't stop there. They can get more cash if they need to. And they've done so. Last week, it bought in nearly 4 billion by selling stock and convertible debt. The amount could increase by 15% depending on demand. It will also receive the remaining 1.6 billion of CARES Act payroll funds by July. When we look at airlines, the biggest question on people's mind is, when will they start flying again? And will they have enough cash to survive, or ultimately will they go bankrupt? With no additional capital raising moves and a very modest recovery in demand, Southwest should end the third quarter with at least 10 billion of cash and investments. That's the third quarter of this year, guys. Keeping in mind that their quarterly expenditure right now will be about 3 billion, and more than likely they could potentially even lower that going forwards. And this article here is great, right? A lot of people are looking at American Airlines. One quick line: they ended Q1 with 6.8 billion of liquidity, barely more than Southwest, despite burning cash twice as fast. It also has more than 34 billion of debt and lease liability. So I know American Airlines is a bigger airline, but their balance sheet is not quite as nice as Southwest is right now. And looking at this, Southwest is still down 50% from their highs, with a pre-market drop of 7.2% on the way. Nobody knows how low airlines, cruises, casinos, hotels, any of those things are going to go down this month. We really don't know. The market makes no sense right now. Just because one man, Warren Buffett, sold all of his shares, I don't think we're going to see the biggest movement in the world that a lot of people are predicting. But again, if you're a long-term investor, these prices are going to be absolutely amazing. Obviously, the short term, however, is going to be very scary, and I know a lot of people want to try timing the market. They want to get in at the bottom. If you do that, you may well never get in. Right now, Southwest are down about 6.5% pre-market. Jets, which is like the Airlines ETF, is down 7.24%, so they're outperforming that. And the Dow Jones is down 2.5%, so they're down quite a bit. It's to be expected. It's not as bad as it may initially look though. And these are words from the CEO. I think we've seen the bottom here in April. Each week after the first week of April has gotten successfully better. I think May will be better than April was, and he thinks June will be better than May was. Now, he doesn't think June will be a good month, but hopefully it will be a bit better than May. That's why Southwest are now on my watch list, and I more than likely will open a position in these guys, but please don't do so just because I said that. I could never open a position, and I'm not a financial advisor. Now, going on to stock number 2, I want to cover Delta. It kind of makes sense to do it second since it's following on from a different airline. I'll try and keep Delta short and sweet because I spoke about them a lot in yesterday's video, but in essence, right now we're down close to 60% from the highs still. Delta pre-market is doing horrifically, nearly 10% in the red. For a long-term investor like me, if I can get my cost base average down from a 10% day in an airline that I 100% completely and utterly believe in, I'm going to do so. If there's a few things I've learned these last weeks, okay, speaking on these videos on YouTube, watching other people speak, it's that nobody knows where the bottom is. Nobody knows when the next pullback's going to be, and nobody knows when the next drawdown's going to be. I, for one, am completely and utterly done with trying to predict what day is going to be red, what day is going to be green, because the market doesn't make sense. And even when the market does make sense, nobody can predict those things. So I decide that I like a stock, I decide a rough range that I'm happy to buy said stock, and then I just keep buying that stock no matter what happens. Now, obviously, I do prefer to buy on red days. I prefer to buy when the stock is cheaper. And that is exactly why Delta is the second stock I'll be watching today. And this is Delta's Q1 earnings. I've spoke about these again a lot, but just a few really quick points. We received 2.7 billion of the 5.4 billion that's expected over the next few months, 3.8 billion of which is direct aid, with 1.6 billion in a low interest unsecured 10-year loan. They expect to have at least 10 billion in liquidity at the end of the June quarter. So again, they expect to have an absolutely fantastic amount of cash on hand come the end of June even. Since early March, we've raised 5.4 billion in new financing and will likely raise several billion more this quarter. They've taken action to reduce their total cost base by over 50% in the June quarter. Starting this month, they'll be spending 50% less on a daily basis. Their operating expenses will be about 50 billion a day as opposed to 100 billion a day. With the amount of cash they have on hand, and they expect to have the end of June quarter with the ability to go into more debt and receive more cash, in my opinion, they're in a fantastic position. I love these guys. They're still my #1 airline. I'm going to leave them there though. There's no need to speak about them. Let's get on to our third one. Now guys, a company I haven't spoke about in a very long time on the channel. There was a stage we were making video on these guys every 2 or 3 days because there was so much news. Carnival Cruise Cup. You all know who they are. You probably all know that they hit $8, then they hit just under $8, then they shot up above $16. Now we're currently sitting at $13.93 with a pre-market loss of about 7.5%. From their highs, they are still down 73%. They were as low as down nearly 85%. The reason I'm bringing these guys up in today's video, and the reason I will start keeping an eye on them again, is what Warren Buffett said about the travel industry changing. And I mentioned at the start of this video, that's not only going to affect the airlines. Just because he sold his airlines doesn't mean they're the only sector affected. Cruise ships will be affected. Again, casinos and hotels will be affected in the short term based off of his statements. So if you missed the bus on Carnival, if you thought about getting in at the $8 mark and you decided not to, you may get another entry point relatively soon. Maybe this week, maybe next week. Look at the rally they made in less than a month. 110% from their lows to their highs, guys. I mean, it was an absolutely fantastic run. But keep in mind that even after that 100% gain, they're still down nearly 68%. One thing about any cruise line company right now, they are getting so much bad press for a very good reason, but it is just attack after attack after attack. I'm absolutely amazed that Carnival went up over 100% in the month of April. The road to recovery for cruise ships is going to be more than likely considerably longer than these airlines. Keep in mind that airlines are essential. They are essential. People need these to get to places. Cruise lines aren't essential. So measures may be kept in place longer for cruise line companies than for airline companies, just because governments need planes flying. They don't need your little family of 4 to be on a cruise line in the middle of the ocean drinking beer and sitting in the jacuzzi. They don't need that. It's not what they need. About 100,000 crew members have been stuck on cruise ships since the industry shut down 7 weeks ago. But there is also a lot of promising news. Despite the bad old Roni, people are still booking a record number of cruises. When we look at it from a logistical point of view, the people who book their cruises still want to go on them, and they will book them as soon as possible. These are people who want to go on holidays, you know what I mean? They're people who more than likely have a decent bit of money, and they're people who are in lockdown right now, stuck inside of their own houses, who are supposed to be sailing the ocean, having the time of their life. Look at this for me, right? 32 million passengers were set to travel on cruise ships in 2020, obviously before this whole situation started to happen, up from 30 million in 2019. Since 2009, cruise ship passengers have grown from 17.8 million to 30 million, an annual growth rate of 5.4%. So this is an absolutely booming industry, and when it is up and running again, it will most certainly continue to boom. And why do I like Carnival more than any other cruise line operator? Because they have 47.4% of all passengers and almost 40% of all revenue in the cruise line industry. They are the biggest out there by a long mile. Some people bring up in the comment section, oh, but Royal Caribbean or Norwegian cruise lines are a better quality. I don't care about the quality, I care about the numbers as an investor. And these numbers are the best ones. When do they have to be up and sailing again? They believe the company has enough cash to survive even if it generates no revenue for the rest of the year. It's expected that, towards the end of the third quarter, at the very latest, cruise lines will be operating again, but obviously it's all speculation, anything could change. But even with this being said, man, they could always get more money, they can take on more debt, they have investors who want to do so, they can definitely survive going into next year even if there is 0 cruises around. But anyway, that's where I stand with Carnival. It's not a full video on them, Jack, don't drag this out too long. So on to stock number 4. Taking a break from the travel industry for a minute, I'm looking at a REIT. So I'm looking at National Retail Properties. We have a dividend safety of 70, a dividend yield of 6.52%. Let me scroll down for about 8 days, oh my goodness, and an uninterrupted dividend streak of 30 plus years. A lot of you guys might not know who these guys are, so we'll speak about that a little bit now. They follow a sale leaseback model in which it will buy a property from an existing tenant and then rent the property back to the former owner under long-term 15 to 20 year contracts. The average remaining lease term is 11.4 years and just 5% of leases expire through the end of 2020. So these guys have a lot of business to get through this short-term, pandemic. These guys are essentially landlords for massive chains. What I like about these guys is how diversified they are, right? The first predictable business model characterized by a highly diversified portfolio of properties leased out to financially strong tenants. For example, the top 25 tenants generate just 58% of its annual rent, and no single company represents more than 5.5% of its annual revenue. So just because one company starts to do really poorly, it won't hit these guys particularly hard. So here are their top tenants, a lot of which I'm positive you'll know if you're from the US, but even if you're not, 7-Eleven, LA Fitness, Camping World, if you're in, the stock market trade, you're going to know these guys. Now, quick look at the balance sheet. Total assets 7.43 billion, total liabilities 3.1 billion. So in a time like this, a balance sheet like this is absolutely beautiful. You love to see it. The company's average annual total return for the past 25 years has been 13.6%. Beautiful. And they have grown that dividend for over 30 years, which again is beautiful. And again, that is one of their main selling points. When you go to their investor relations page, you will see them speak about this a lot. So when they fall on tough times as they have now, they're going to do everything in their power to keep paying this dividend. And when you look at their balance sheet, they are going to be able to continue paying this dividend. And these guys are still down about 45.5% from their highs, so they're still a very cheap stock. What I really like about these guys is when you go to their investor relations page, it is so simple to follow along. So many companies make it so complicated. These guys make it so easy. They have this consistent and simple strategy. You read this and you understand what they do. Long-term investors of single-tenant, freestanding retail properties, no malls or strip centers. They avoid retail categories most susceptible to e-commerce threat, sustain high occupancy and maximize value of existing real estate assets. You can see here at the end of last year they had 99% occupancy. It's easy to understand. They have a really good business model. They only work with relatively safe companies. They're extremely diversified and they have an amazing dividend, and they're still down about 45% from their highs. So that was stock number 4. Now on to stock numero 5. The final company I'm going to speak about today is actually NAT, just because I keep getting so many questions about these guys from my last video. I was going to speak about Boeing, but I'm actually going to save that for a future video. So if you watched my video, you'll know that right about here, Tuesday the 21st of April, is when these guys started getting an awful lot of attention in the media. And what happened was they went from here all the way up to their highs of 44.49%. But that is not completely true, because if you watched my last video, you know that they very briefly briefly hit $9. So they actually went up almost 80% in about a week. Now since then, they've come back down to $6.12. Okay, so they've come down, you know, from where they closed 16.6%, but realistically from the very tip top highs 30%. And you'll see that the 52-week high here, 9, that was right here. I previously said that I didn't plan on buying these guys. I didn't plan on getting into, you know, these oil tanker stocks because I'm a long-term investor, blah blah blah. Also, I know a deal when I see one. And there is immense short-term potential here for at least the next 6 months, upwards of 9 months. They're making about 1.4 million profit every single day. The large majority of their contracts, to the best of our knowledge, are for 6+ months as well. So it's not like, you know, when oil prices start to go up, they're just going to lose all of their money. It won't happen. And if I can make 100 to 150% in a matter of 6 to 9 months, it's worth a shot, you know what I mean? So I'm definitely not sold on investing in these guys yet. The other stocks we spoke about today, I want to get into. These guys, I'm still somewhat uncertain, but one thing is for sure, I'm going to be keeping a very, very close eye on them. And if they get to a price that I am extremely happy with, I will be getting in. The volatility lately has been crazy, and it has been because they just got so much attention in the media between Jeremy from Financial Education and the CEO speaking with Jim Cramer on CNBC. The amount they've been able to charge on a daily basis has gone up extremely exponentially, okay? In Q4 2019, the Suezmax spot market increased 76.9% from 17,300 a day in 2018 to 30,600 a day in 2019. To put this into perspective, these tankers are averaging 62,000 a day in 2020 and $112,800 a day for the week of April 24th. Okay, do you understand how much more money these guys are making? These earnings as of last week are 6.52 times their Q4 2018 report and 3.6 times their Q4 2019 report. They're making a lot more money. And that has absolutely insane short-term potential. Probably the most short-term potential out of any, you know, relatively big stock. And their dividend is more than likely going to be insanely big for the next few quarters. Long term, I still have no interest in these guys. I really just don't. But the short-term potential is mental. Again, I don't want to get too into these guys. Go watch my last video on these guys if you haven't. I'll have it on the screen somewhere. I'll have it in the description. I don't know. But with the amount they're charging now and the amount more that they could charge, it's crazy. And these guys already have a very good balance sheet. 129 million current assets, 1 billion total assets, 59 million current liabilities, and 435 billion total liabilities. So a fantastic balance sheet, and they're going to be able to pay off all of their debt in a few days' work. They're going to be completely debt free. They're going to be making a lot of money. They're going to pay a massive dividend, and their stock price will more than likely go up over the next, 3 to 9 months. So guys, they are 5 stocks that I'll be watching very closely this week. The first 3, 2 airlines and a cruise line. More than likely, those guys will be hit extremely hard. The fourth one, the REIT. They may or may not be hit hard. They already have been hit very hard. They have a fantastic balance sheet. They have fantastic fundamentals. I most certainly want to buy them. And the fifth one being NAT. Who knows what's going to happen with them in all honesty, man. But their short-term outlook is very good. Do keep in mind though that all of the stocks I spoke about today, bar potentially the REIT, are very speculative. And nobody can really tell you what's going to happen in the short term with these guys. Absolutely anything could happen. We've seen, how temperamental the stock market has been of late. We've seen just how much news has been moving the market as of late. So always tread lightly, be careful, make sure to do your own analysis. Don't just buy something because I or anybody else speaks about it. Again, I'm not a financial advisor. These are all just my thoughts and stocks that I personally will be looking, and some of them will hopefully be buying. If you enjoyed today's video, please do remember, hit it a like, drop me a comment right now with your thoughts on any of the stocks I spoke about or any stocks you're watching. I always love speaking with you guys, and it actually helps me out. And subscribe if you're new around here. And I will speak to you all in the next video, which as always will be tomorrow. Peace.